Good afternoon, friends. We'll discuss about lesson 8 now, capital budgeting. We've discussed this in detail in project management, but we have this unit in common in financial management as well as in project management. But we'll look into this in here. Now, let us go for capital budgeting. There are two topics which we need to discuss: capital budgeting and methods of capital budgeting. This is, I would say, extension of the chapter time value of money. So, if we have if you forgot the concept of compounding and discounting, I would suggest go back into time value of money chapter and watch it again. Now, what is capital budgeting? It is investment decisions related to long-term assets are called as capital budgeting. So, capital means long-term sources of finance, and budgeting is when you make financial future plans or future plans in terms of finances. So, if you look into this, capital budgeting says that planning in financial terms for the capital which you have acquired. So, for example, a company has issued new shares or has got new long-term sources of funds for about 10 crore or 15 crore. Then the way in which it is to be deployed, it is a matter of concern. So the company should decide the way this 10 crore or 15 crore is to be deployed, is to be invested, so that maximization of profit can be done. And that is the way, that is the main idea behind capital budgeting, where we have various techniques to decide in which project we have to invest and which project we don't have to invest, what is the project we have to select and which is the project we don't have to select. What are the features of capital budgeting? It is always related to long-term assets. It is also leads to future returns for current investments, measured in terms of cash flows, cash inflow and cash outflow. Single project or a mutually exclusive project, there can be just one project. Then acceptance or rejection based on maximization of the value of the firm. So if the value of the firm is maximized, then you accept it, and if value of the firm is not maximized, it is not accepted. What is the importance of capital budgeting? It has long-term effect. It is risk, and it has risk and uncertainty because it is long-term. Nobody can predict future. So hence risk is also, plus a huge sum of money is also involved. So it involves a lot of risk and uncertainty. Large funds are involved. It also impacts the corporate image. In case if projects are going bad one by one, then it hits corporate image like anything. Now, difficulties in capital budgeting: biggest problem is future uncertainty. Nobody can predict future. Here in capital budgeting, we are dealing with the future cash flows. Time element, time value of money is very important in capital budgeting. Measurement problem, biggest problem is measurement, and the biggest problem is what to take as rate of discounting. So determination of rate of discounting is also a big problem. Now, capital budgeting process: it is identification of project. First of all, you identify the project, then assembling of the proposed investments, and decision making, preparation of capital budget and appropriations, then implementation, and then project review. So this is capital budgeting process. First of all, you identify the project, then assemble the project, proposed investment, then decision making that yes, we are going with this project, and then preparation of capital budget and appropriation, and you implement the project, and then you go for performance review. Now, factors influencing capital budgeting: first one is availability of funds, future earnings, legal compulsion, degree of uncertainty of risk, urgency, research and development projects, obsolescence, competitors' activity, and integral factors. So these are the various factors which affect capital budgeting decisions. What are methods of capital budgeting? There are two kinds of methods: traditional method and modern method, or you can also call them as discounting. Non-discounting techniques are also known as traditional techniques, and discounting techniques are called as modern techniques. So non-discounting techniques, there are three basic non-discounting techniques: payback period, post payback, profitability method, and accounting or annual rate of return. Now, in modern technique or discounting techniques, discounted payback period, net present value method, IRR method, profitability index method, and cost benefit analysis method, we have discussed all these things in project management, so it would be easier for you. Payback period, we already know the payback period is that length of time required to recover the cost of an investment. So it is a time period within which the investment will come back. Whatever investment we have made will recover back it from the project. It's a rule. The project with the shortest payback period is selected. If you look into this, there are two approaches. Shortcut method, first of all, initial investment divided by annual operating cash flow amount. It is in the case when cash flow is constant, and if in case cash flows are not constant, then you make cumulative of cash flows, and then you decide in how many years you are getting back your investment, and that is your payback period. What are the merits of payback period? It is simple to operate, liquidity indication, and risk of obsolescence is high. So as the risk of obsolescence is high, most of the technology things, they are becoming obsolete. In a quicker manner, we can go for payback period method, because a project which gives you sooner returns will be accepted. Now, demerits, it ignores cash flows after payback period, gives equal weightage to all the cash flows, it ignores the salvage value, and it is a method of capital recovery. That's it. It doesn't consider profit as the motive, rather it is just considering the capital recovery as the only criteria to select the project. Post-payback profitability. Under this method, the cash inflows after payback period is taken into account. So, for example, there are two projects, both A and B, and both require initial investment of 1 lakh rupees. In project A, if you're getting 20,000 per year for 5 years, 30,000 per year for 5 years, then after 3.333 years, you will be having your payback period, because you'll be able to recover your 1 lakh rupees. In second project, you're having 4,000 per year, and that is for only 4 years. Then it will be 2.5 years will be your payback period, because you'll be able to recover 1 lakh rupees. Now, considering this, let us take the first project, A project, where 30,000 rupees per year we were getting for 5 years. So total of 1,50,000 will get, and 1 lakh is our investment. So post payback profit will be 50,000 rupees, and post payback profitability will be 50,000 rupees divided by initial investment, that is 1 lakh rupees, that is 50%. And for project B, it will be 40,000 per year for 4 years. So 40,000 into 4 is 1,60,000, and 1 lakh is initial investment. So 1,60,000 minus 1 lakh is 60,000 rupees, and profitability will calculate by dividing this 60,000 with initial investment, that is 1 lakh rupees, that is 60%. So we'll select the second option, B project. Now, accounting rate of return or annual rate of return. Accounting rate of return is also known as simple or average rate of return, measures the amount of profit or return expected on an investment. It divides the average profit by an initial investment to derive the ratio or return that can be expected. ARR does not consider the time value of money or cash flows, which can be an integral part of maintaining a business. So average rate of return is annual average profit divided by average investment. What are the merits? It is easy to calculate. It considers entire cash flows. It is based on financial data. Demerits, it ignores time value of money. Cost of project cannot be determined accurately. It cannot be used as only way to appraise the project. It uses only accounting figures, and problem of comparability is there, because accounting principles may vary from firm to firm. Now, discounted payback period method. Discounted payback period is the capital budgeting procedure used to determine the profitability of the project. The discounted payback period gives the number of years it takes to break even from undertaking the initial expenditure by discounting future cash flows and recognizing the time value of money. So what normally happens, it is similar to payback period. The only thing is we are discounting future cash flows and we are finding the time value of money, what future cash flows will value today, and then we are calculating the present value of money. What are the advantages? It considers the time value of money, it considers the riskiness of the project's cash flow to the cost of the capital. If the project ever pays back on the discounted basis, it must have a positive NPA. And NPV. Disadvantages: may reject positive NPV projects, arbitrarily discounted payback period, and bias against long-term projects. So biggest problem here is to determine R, and it is also biased against long-term projects. Now NPV method, net present value method, is the difference between the present value of cash inflows and present value of cash outflows over a period of time. Present value is equal to future value divided by 1 plus I whole ki power, and we have already discussed this when we were discussing about the discounting. The decision rule is NPV is more than 0, then you accept the project. If NPV is less than 0, you reject the project. And if NPV is equal to 0, it is indifferent whether you accept it or you reject the project. Now merits: recognition of time value of money. It is a sound method of appraisal because you are considering time value of money. You are comparing with the present value of cash inflow minus present value of cash outflow. Selection of mutually exclusive projects. So in case of selection of mutually exclusive projects, NPV should be more than what is required. Wealth maximization, it leads to wealth maximization. Demerits: it is difficult to understand because discounting and tedious calculation is involved. May not give accurate decision because of IRR. If we compare this with IRR, then IRR gives you better picture than NPV. Difficult in calculation and absolute measure. It is an absolute measure. Now let us go for IRR. IRR is the interest rate at which the net present value of all the cash flows, both positive and negative, from the project or an investment equal to 0, which means it is the rate of return, the rate of the discounting rate at which the present value of cash outflow is equal to present value of cash inflow. Hence NPV will be 0 at IRR. So if we look into internal rate of return, then it considers time value of money. It is easy to understand. It indicates profitability is consistent with overall objective. And demerit is tedious calculation, most difficult calculation in capital budgeting, confusion in multiple rates. There are various rates in which we have to calculate the present value, and hit and trial method is to be used, so it leads to a lot of confusion. Inconsistent in maximizing shareholders' wealth, reinvestment of cash flows, and ignores rupees of NPV. Now if we compare NPV and IRR, then NPV method result in a dollar value. So NPV is calculated in dollar value, in rupees value, and IRR is generated as a percentage return. NPV method focuses on project surpluses while IRR is focused on break-even cash flow level of the project. This in support, the NPV method presents an outcome that forms the foundation for an investment decision, since it presents a dollar return. The IRR method does not help in making this decision, since its percentage return does not tell the investor how much money will be made. Reinvestment date. The presumed rate of return for reinvestment intermediate cash flows is the firm's cost of capital when NPV is used, while it is internal rate of return under the IRR. Discount rate of issues. NPV method requires the use of discount rate, which can be difficult to derive since management might want to adjust it based on perceived risk levels. The IRR method does not have this difficulty since the rate of return is simply derived from the underlying cash flow. Now, profitability index. The profitability index is present value of cash inflow divided by present value of cash outflow. If you try to remember what is NPV, it is present value of cash inflow minus present value of cash outflow. And what is cost benefit analysis? It is simply 1 divided by profitability index. And what are the advantages and disadvantages of profitability index? Advantages: it is closely related to NPV, generally leading to identical decisions. Easy to understand and communicate, may be useful when available investment funds are limited. And disadvantage: may lead to incorrect decisions in comparison to of mutually exclusive investments. In mutually exclusive investments, it becomes very difficult to take decisions on the basis of profitability index or NPV. With this, we come to end of the capital budgeting. I hope you all enjoyed this session. In case if you have any doubt, please give me a buzz. Thank you.